The basic concept of stock markets is pretty straightforward. If you know the true value of something, you can save a lot of money when you buy it at a low price. For example, if you buy a mobile phone at a 30% discount or at a full price, you will end up buying the same phone with the same features, the same camera, and the same memory. Similarly, the stock prices can change even when the company's value or valuation has remained the same. However, the only difference here is, unlike mobile phones, the stocks won't be displayed on sale at predictable times of the year such as Diwali, Black Friday, or Christmas, and their sale prices won't be advertised. So, as an investor, you need to conduct the research to find out the stocks that are available at low prices and have investing opportunities in them. So now, let's look at the steps for this research for your investing needs. The first component is the industry analysis. An industry has various subparts. For example, if you look at the automobile industry, it has various segments like the passenger vehicle segment, the commercial vehicle segment, and the 2 and 3 wheeler segment. And then comes ancillary industries, for example, tires, batteries, engine manufacturers, etc. Therefore, it is necessary for you to focus on the relevant industry segment where the company falls. The first thing in industry analysis is to focus upon the industry dynamics, how the industry functions, and the micro and macro factors that affect the industry. Investors must avoid industries that they don't understand. For example, I generally prefer to avoid the commodity sector as it requires a different level of expertise. The market is very hard to predict and it is mostly affected by micro and macro factors. So, after picking an industry which you understand, research on the present outlook and the future scenario of the company. How is the revenue visibility like? How many competitions are there in the market? And what is the competitive intensity of the industry like? After this, analyze the legal factors as well, such as regulations related to labor laws, tariffs, taxes, and check whether these regulations are favorable for the industry or not. For example, if I talk about the sugar industry, the industry is highly regulated. The quantity of the sugar to be sold and exported by mills is also decided by the government. The government also regulates the prices by deciding the FRP. Fair and remunerative prices are the prices that a local sugarcane farmer gets for his cane. So the government leaves no scope for the farmers to negotiate, making this industry highly unattractive. The next component is analyzing the business or the company. Two companies operating in a similar industry, offering almost the same kind of products and services, may have entirely different business models. Say, for example, Big Bazaar and D-Mart both are into retail chains, and yet their business models are entirely different. Big Bazaar carries out its operations through its retail premises, and D-Mart carries out its operations through its own stores, and thus they have different profitability, different turnover, and even different margins. Now, it is upon you to figure out which business models are doing well and will continue to do so in the near future. Now, moving on to the third component, management. Many legendary investors believe that management is the most important part of fundamental analysis. It makes sense, right? Because even the best businesses can be ruined if the leaders of the company do not execute the plan properly. Now, if we take the example of Kingfisher, if you remember, it was the most famous company in the aviation and liquor industry. Despite of having steady cash flows and profitability, the company managed to ruin the shareholders' wealth because of over-ambitious and irresponsible management. Therefore, it is equally important to analyze the company's management before making any investment decision. Now comes the final component, valuation. After analyzing the company and the industry, you need to figure out the right buy price. For this, you need to conduct a valuation analysis to figure out if the share price of the company is currently trading at a fair value, at an attractive value, or at an over-expensive valuation. There are a few frequently used methods that you can use to estimate the fair value of a company. However, you will learn those in the upcoming chapters. While going through this process does not guarantee that you will make extraordinary returns, but it does guarantee that you will make better than market returns.